Hey, my friend, Barry Burns here with TopDogTrading. Today we're going to talk about stock market cycles, Forex cycles, anything that has to do with trading cycle indicators in the financial markets. And this is really important. This is going to give you a huge edge because what's interesting is as I was doing some Google searches and YouTube searches to see what else was out there on this topic, first of all, I found out that there's not many people doing searches for this. So then I thought, well, maybe I shouldn't do a video on it if people aren't searching for it. And then I thought, no, just the opposite. I definitely need to do a video on this because if there's very few people using this and I share it with my subscribers, well, then I can give you an edge because that's kind of what an edge is, seeing things that other people don't see, they're not even looking for. And this is so important. So we're focusing on cycles today. And what I mean by that is your timing in the market. Now that appears in many different ways, but first of all, again, just to emphasize the importance of this and how absolutely ridiculously critical this is. So think of it this way. A chart has two dimensions. It's a two-dimensional object. We've got time axis on the bottom. What the heck, I'll draw it down here. And that's your x-axis. And then we've got our y-axis here. And I'm not very good at writing with a mouse, but we'll just put in here a little bit. There's your price axis and there's your time axis. All right, so think of that. Now, if you are not using some sort of really great timing tool, what are you doing? You're missing out on 50% of the information on the chart. Well, dang. Trading is all about establishing probability scenarios that favor us, right? So how can you even do that? How can you establish a statistical probability scenario if you're ignoring 50% of the information on the chart? I think you know the answer to that. You can't. You won't. And you're doomed. You are doomed. That alone means that you will be a failed trader. Now, how this manifests itself in a lot of people's actual trading experience is they'll say things like, oh, Barry, I keep getting in and then I get stopped out. And then after I get stopped out, the market goes back in the original direction of my trade. And I keep getting stopped out all the time, but I was right. And one of my friends who is a floor trader, actually was one of my mentors for quite a while in Chicago, and he said, Barry, you know what? Retailers are often right, but at the wrong time. And that's what he meant, is that experience that some of you are having where, okay, you got an uptrend and you bought, but your timing was off, so you got stopped out before the market continued going up. And so that's it, timing at the wrong time. Time is everything, and especially in today's markets, you can't be as sloppy as you could back in the olden days when I started trading. No, with high-frequency trading, algo trading, the advent of decimalization, lowering of commissions, the commoditization of direct access, and all this kind of stuff means that markets don't trend as much as they used to. They're choppier, they're noisier, and so you have to be more accurate. And the way you do that is by learning how to time your entries. Now, as I just showed you, there's two dimensions on the chart, but W.D. Gann, the famous trader, he said they're not even equal. Of the two, time and price, time is actually more important than price. And yet very few people even use this in their trading in any way, shape, or form. So I'm going to do a quick little series here on how to do this with various types of cycles. So when you're talking about cycles in the market, that's what we're talking about is timing. So today, I'm going to give you a quick overview, and then we'll do some specific videos in the future. Actually, you know what? We'll do a little bit on that first one. So there's seasonal or calendar cycles, and then there's volatility cycles. We'll do that in a future video. We'll cover the first one today. And then order chaos cycles. Now that one, wow, that's one that I have never heard anybody else talk about except me, although I'm sure somebody has. Coupling and uncoupling cycles, that's actually one that professional traders do a lot. And the up-down cycles, that means timing your entries with the highs and the lows, the swing highs, swing lows. And that one I actually have a great indicator for, by the way, which I give away for free. So that one is where you get very, very precise into exactly where you enter to help you to prevent being stopped out. whether it's long or short. If you're interested in that indicator, I'm happy to share it with you along with the tutorial. Just send me an email at barry@topdogtrading.com. I won't be covering that in this video because it takes longer than our 10 minutes allotted for these YouTube videos. But happy to share that with you and for free in the tutorial. Just send me an email. We'll get the information over to you. So today what I want to focus on is this one, the seasonal or calendar cycles. So what we're talking about here is the time of year, basically. And this is most famously used with the agricultural markets, where they said, okay, well, you farm and you sow your seed in the spring. The crops grow over the summer, and then you reap your harvest in the fall. So if you're going to trade soft commodities, such as corn or wheat or whatever, then it would make sense, logically, to go ahead and to buy those commodities in the spring. And then when they sell the commodity in the fall, then, that's when you sell. The price goes up and you're cool. You're golden, right? Not quite that easy. We'll talk about that in a moment. But that is a cycle, the agricultural cycle. And then another one is the retail sector. So as I'm recording this, we're just about a week before Christmas. Actually, it's exactly a week before Christmas, now that I look at the calendar. And regardless of your religious affiliation, this is a time when retail markets do often quite very well, right? There's some businesses, in fact, that they make all of their money during the holidays in December. They pushed it even into November now with Black Friday and all that kind of stuff. So they keep extending it. But the bottom line is, these couple of months here, we'll say, is when some businesses actually make all their profits, and others make the majority of their profits during this time. So people who are watching the retail stocks and sectors, things like that, they are watching this time of year. Third one is travel. So again, timing is very important for that. Most people do their traveling during the summer or during spring break or during certain holidays. Again, maybe during Christmas, Kwanzaa, Hanukkah, time when people have available to go visit family and friends. And so if you're going to invest in airlines or hotels, things like that, then this would be a time that you'd be looking at those types of markets, and you could do some swing trades around that timing. Now, here's the problem. So you get the idea, and there's many other cycles that are associated with the calendar year. But here's the problem. They're not always consistent. So you can't just trade a calendar. You have to learn to read the charts. And the reason for that is, well, let's just take the retail sector. No, let's take the agricultural sector. So, because this is how futures were created. So let's say that our friendly farmer, he sows in the spring, and then a disaster happens. A natural disaster with weather happens over the summer, and his crop is destroyed. When I lived in Florida, we'd see this a lot with orange juice. So the oranges would sometimes have a freeze, or the weather would freeze, and the oranges would die. And that really had a major dramatic effect on the orange juice commodity market. So prices would go up because why? There wasn't the same kind of supply that they had expected. And so now if you wanted orange juice, well, you're going to have to pay a lot more for it. But the problem is the farmers got hurt. And so what farmers decided to do is they said, hey, because some farmers lost all their crops. So you might say, well, price went up, so that's good, right? No, because some farmers lost all their crops. They made zero money. They invested all that money into farming, into the machinery, into raising the crops of whatever it was, wheat, corn, whatever. And now they got nothing back. So they are deeply in debt. So speculators came along and they said, hey, tell you what we'll do. We'll give you kind of an insurance policy. We'll buy your crops in the spring before they're even grown, let alone harvested. And we will give you a price now, but we want a discount. But basically, you're guaranteed this price. And so they're betting on the future, and they're mitigating the risk for the farmer. So the farmer gives up a percentage of what they would normally make, but they've got insurance, a type of insurance, so to say. So a lot of farmers said, cool, that's fantastic. I would rather have the guaranteed price. I can't weather, pun fully intended, by the way, the risk of a horrible weather. Even if it just happens to me once every 5 years or once every 10 years, it is so devastating that I'd rather smooth out my equity curve, so to say. So that's the thing. Agricultural markets, you can't trade the calendar because what will happen? So you trade the chart. The retail sector is actually a better one because agricultural, weather events are very difficult, in fact, impossible pretty much to predict. Now, in the retail sector, we can start watching for some leading indicators because it's more driven by the economy in general. How are people doing? Are they making a lot of money? And that sort of thing. And so if people are feeling that they're prosperous this year, they're going to spend more money on presents. And if they're not, then they're not. So people can start looking at these economic indicators ahead of time. And that, again, is the deal. So with traders, with speculators, we're trading these times of year, but we're not waiting to buy in the spring. We're not waiting to buy in November. So traders often trade the retail market starting in like August. Yeah, August. Because by the time everything's known, the deal is done. The trade is over. So it's like the saying, buy the rumor and sell the news. Because by the time all the information is known, then the pros aren't trading that anymore. It's too late. You got confirmation, but there's no opportunity for a trade. So same thing in all of these. So therefore, you've got to be able to read a calendar you read the calendar, but you use that for some timing and you do what Dow theory calls discounting the market, which basically means just what I said, is to trade in advance before all the information is known. And hey, that's why it's called speculation. You say, but isn't that risky? Yep, it sure is. And that's why we call it speculation. So the last thing I want to say here is that using these types of cycles, in fact, any type of cycles, is just one energy in the market, what I call energies. And the energy of money is what I'm talking about here. Money going in, money going out, the buying, the selling, the supply, the demand. So you don't trade cycles alone, not even the calendar and a chart. You still need other things. But this is one extra thing that you can add to your trading, and professionals definitely do this. So if you like this video, please understand that, yep, it's free, but not spiritually. It's kind of a weird thing to say. What I mean by that is that if you did get value from it, please pay it forward. Just pay it forward. And the best way to do that is to click the share button. Hey, we're over 30,000 subscribers now. It just boggles my mind. So we're totally on our way to world domination here. And, well, maybe not quite that. But I'd love to have you as a subscriber if you're not already one. And just click the subscribe button. And that way you'll get notifications every time I come out with a new video, which is about once a week. And again, obviously, this is all for free. So great stuff for you. And I enjoy sharing it with you. Click the thumbs up icon. Leave comments below. I love your comments. Anything you want to add. If you disagree with me, if you agree with me, if you have something to add to the community on the topic, it's all great. And then the big special offer I have right now for you is I'm giving away one of my favorite trade strategies. I call it the rubber band trade. I get people emailing me all the time telling me that they're making money with this. So I'm very excited about that because I give it away for free. I want to give you value ahead of time, and real value, not just general teaching, but also stuff you can make money with. And that's what this rubber band trade is. I don't charge for it. It's a simple trade, and I can teach it to you in about 26 minutes. Get it absolutely free by clicking on the image in the top right corner of the video or in the description below the video. And if you're not watching this on YouTube, there's probably a link below or an opt-in form on the side. Once you do one of those things, I will personally email the video to you with the rubber band trade strategy.